We have here four of the great and the goods of finance and energy coming from all corners of the world and all people with a big heart and the determination to do good. Currently, about $354 billion are invested in renewable energy. Only 13% of that invested in emerging markets, not including China. What's the matter? What's missing? How do we scale? What are the hurdles? This is what we want to extract from these fantastic people. I'll start with you, Samir. You're leading the charge in one of the largest banks in the world. You want to do good. You want to generate return. You know how to evaluate risks. What is missing so that we can scale up and address those issues?
Well, thank you, Madame Lagarde. It's a very important topic for actually all of us, our children, but as well our economies. Emerging markets, by the United Nations report, need almost 2.5 to 3 trillion per year.
That's
investments.
At least 6 times what I've just mentioned.
Exactly.
And in emerging markets, it's even more.
So we see the gap still between what is needed to help developing and emerging market transition to a low carbon energy versus what we are doing now. So what we need is focus on how do we scale up what we are doing now. So it is only mainly a question of scale. And in my view, to scale up what we are doing today, we should be working much more closely, the private sector and the public sector, providing the financing needed. I think that there is a lot of finance available. What is needed is how do we organize ourselves? Private sector will probably provide most of the debt, and the public sector, is it the international banks, the development banks, or the national development banks would need to provide the guarantees or the equities that de-risk the private sector in this approach.
Okay, so if I get it, the public takes the risks and the private takes the profit.
Well, it's a bit more subtle than that.
I'm sure it is.
In the sense that the public sector needs just to put the guarantees, that allows the private sector to go, and
you pay for that. You pay the price for that guarantee.
And we will pay the price, and everyone is ready to pay the price, and no one would. It's not philanthropy. It's really for profit, but for profit for all.
Okay, so public-private cooperation, de-risking a portion of the project, and then the scaling is possible. Francesco, I know that you are moving into a new financial construction, and you address that issue partly. Can you tell us a bit more about your transition bond?
Yes.
And jump on anything that Samir has mentioned.
What Samir said is absolutely right. Maybe we should also be aware that the amount of investment money available for this kind of endeavor is really large, much larger than what is needed. Actually, there is an excess of offering from the market. The question is how to channel it, how to vehicle this investment. And so far, of course, debt market is there, and the bond market has been active only on green bonds, basically. Nothing wrong with green bonds, but green bonds have been a very useful tool so far. It's still there.
But there's not enough of it.
But let's say that they are cumbersome. It's a tool that has its own complexities, and not all companies can afford the complexities, not all investors want to bother with them. So it's a little bit of a limited vehicle. So we started to see what can be done, and we worked around this market and launched this bond that was issued a couple of weeks ago. It's not a specific bond for that investment or that investment. It's a $1.5 billion bond in the US bond market, linked to the company reaching certain goals of renewable capacity by year 2021. A discount on the commercial bond market because it is a less risky proposition if we grow renewables. and of course an increase in the interest we pay if we don't meet this goal.
So you have an incentive to meet the goals.
Yes, of course it's a pretty simple mechanism if you look at it that way. I'm surprised that there's been such a big, but that, the amount of interest that this bond has raised is a testimony of the fact that there is a lot of investors looking for this kind of tools. You will be looking at similar bonds coming up. SDGs are important because they provide the metrics. So you put the metrics.
Can I annoy you on this issue of metrics, because I know that you are very keen on the measurements and the metrics.
I'm an engineer, yeah.
Yeah, fantastic. We have not a financial person, but an engineer, even better. Yeah. Do we have proliferation of indicators and metrics and measurement systems, and how do we combine them? How do we arrive at enough coordination so that it can be reliable and used by all?
I think sustainability is a fuzzy word,
Yeah.
right? So it's not like credit, although credit has also been used in a fuzzy way in some instances. But sustainability is really complex to put your arms around it. So a lot of effort is being put on sustainability rating, rankings, all kinds of metrics. I think it's going to go away. There will be a consensus on a few clear metrics over the years. So we need to wait for markets.
How long will that take?
I think it will take something in the range of 5 years.
Will it require cooperation?
It will require a lot of cooperation and
between
a lot of convergence between the investors, the companies, and the rating agencies, because at the end, someone needs to be there to manage this whole process. So it's a big opportunity in business for rating agencies because it's a complete new environment. But while this happens, we need something. So as you have hybrid cars waiting for electric cars, then we have this kind of sustainability-linked bonds while the system converges to a more holistic approach. And this is, I think, the new movement. By the way, I think structuring SDG-linked bonds, the thinking will converge.
Can you, please.
Standardization is a key factor to scale up. Standardization means principle, disclosure, taxonomy, and then rating agencies involved. Are they these rating agencies or new rating agencies involved?
I hear what you say, but equally, the standardization, when you have to measure on almost a country-by-country, sector-by-sector basis, because while you might decide that an investment in electric cars is great, if the electricity is produced by coal in a particular country, it's not going to be that great in terms of rating. Yeah. So
that's the role of taxonomy.
True, but taxonomies is going to have to be really granular and go down into sector, countries, and very specifically. So, Andreas, I want to go back to my question. What's missing between the 354 billion, meager, relative to the 10 times what's needed in emerging markets?
I mean, I agree very much with what Samir said earlier, which is we need a greater level of cooperation between the public and the private sector. I don't think it's about the public sector making all the profits. It's more about the ability to the public sector to really bring leverage to the table, and that's really going to close the gap between the demand and what's currently being supplied. But picking up on this topic of collaboration, I think what the CFLI has brought to the table, really for the first time, and under the inspirational leadership of Michael Bloomberg here, is to get companies that typically compete quite fiercely in the marketplace, all of us here in the previous panel, to actually work together for 9 months and beyond and come up with joint solutions to tackle these problems. And that's really innovative. And I don't think that in my company, without this impetus and without the pressure that came from that, we would have been able to announce today the launch of our impact fund, which is the first impact fund for European investors, which is a blended vehicle. And that's really, I think, innovative, and that's going to bring us a hell of a lot further down the road in the next 2 or 3 years. I think this is just the start of this cooperation between large organizations to bring this to the table.
What is impact fund? 1 minute.
An impact fund is a vehicle that can invest in debt or equity instruments that is particularly targeted at, for example, fulfilling some of the SDGs of the UN, but particularly measuring the impact that the investment has, typically decarbonization or reducing pollution or poverty or the like. To your earlier point, this is where the measurement and the statistics and the data become very important. And I think the engagement by the asset owners and asset managers with those organizations, be it public or private sector, will become critical in the next few years. I don't think standardization per se is going to be the answer. It's going to be an iterative process.
So who are you accountable to in terms of these objectives that are set?
Well, we're accountable to our own moral standards and to following the lead of the UN SDGs, but ultimately also the asset owners who entrust us with their money. And they often have very different and diverse aims.
And you see a shift in them in terms of direction of investment? And
we talked about it earlier in the back. I think it's about 100% of our clients now feel that this is a very, very important topic.
Fascinating.
I think we've got to be realistic about the fact that when you talk about 3 trillion and a 10 times increase, this is a massive step we need to take. So we've come a long way to get to 300 billion a year. But to get this investment increased, and particularly in emerging markets, there's a lot of challenges we face. As the last panel was discussing, I think there's 300 trillion of savings in the world and about 80 trillion of it professionally managed. It has a bias towards going to the lower risk and more moderate return investment opportunities, especially in this sort of world where capital protection is important to them. And I think the point you made is an important one, that we mustn't forget that stakeholder whose money is invested. These are pensioners, mums and dads trying to provide for their retirement. And we have to balance that with the other stakeholder being the community that actually needs this capital and expertise. And in connecting those two and creating de-risked opportunities to deliver what's needed, a lot of expertise is needed, a lot of patience is needed. So I agree with the last panel that measurement and transparency is super important so that the investors can see and the intermediaries can see what's being delivered and be accountable. But I also agree with Samir's point that public-private partnerships are very important, because in de-risking the investments in the emerging markets, and to your point, it has to happen not just country by country, but project by project, where structures are created to build this project pipeline where we de-risk. Now, places like Brazil, South Africa, India are developing reverse auction mechanisms that help the private money come in. The public money is taking first loss. The concessional finance organizations like the Green Climate Fund are helping. But what we're also trying to do is create structures where the private market can come in. So more and more now, corporates are stepping up with PPAs and off-takes because the cost of solar has come down 90%, the cost of wind has come down, and new build solar and wind are very competitive. In fact, more competitive than fossil fuel solutions, plus the corporates are bringing in their sustainability objectives. So to the extent we can bring corporate off-takes that are particularly US dollar denominated, it's helping bring private capital to these projects without necessarily the public sector involvement, because the currency risks are less, etc. So I think there's a lot to be done brick by brick, but all these solutions our panel are talking about.
Francesco, I'm going to give you the floor one more second, but to give you time to think about it, I'm going to ask you, number one, if carbon pricing would actually be a financial incentive that would work in the various schemes that you consider. And second, I'm Mrs. Nobody for a month in my life, and I might soon be a central bank governor. And I would ask you, because I've asked you what you can do, and I'm going to ask you what a central bank governor can actually do to participate in that process. But you have the floor for 1 second.
I just wanted to add that at the end of the day, it is all about a risk that we're talking about. When we invest in emerging countries, OECD area, developing countries. It's all about the risk profile of the single project. And of course, as we see the unfolding of the energy transition, the risk that we're looking at is that as OECD countries get heavily into the renewable energy transition, they are the fiercest competitor on capital markets with emerging countries, because their risk profile is lower. And we know them, and we know the system year on year. Since we started investing in renewables, every single year, the US market, with the Obama administration and Trump administration, no change in that, has always overshoot the expectations we had the previous year.
Because the risk return is so much more favorable.
It's a very efficient, easy market. So I think really the concern is not that the capitals are not there, but where do they go? You know, where are they selectively going? And I think it's important that what Samir said, you know, the de-risking of emerging market is a critical point if we want to rebalance this trend.
So it's under the combined pressure of the de-risking that is allowed by the authorities and the strength of the asset managers who are themselves, I guess, pushed by the investors and by you and me, that eventually things will change. Let's hope so. Now, I want to go back to my questions. The carbon pricing, would that be a help or not? There's no good carbon pricing around. The average is about $2 per ton of carbon emission, which is way too low. If we had been at the right price back in 2015, the emission would have reduced by 28%. The number of deaths by pollution would have reduced by 45%. We haven't done it. Would that help financially?
It will force definitely the outcome, but we will have to be very careful of what would be the impact on emerging and developing markets. Because the topic here is not to force emerging and developing markets to grow less. We want to continue supporting them growing even more, but transitioning to the low carbon. So I think that pricing is important, but more important than that is to provide to the emerging market and to the developing countries, you know, the right financial solutions, and in a massive way. The second thing you've asked about central banks. Two things for central banks. First, you are reserve managers, so you own assets as well, and you can help actually participating in investing in more green assets, even though it can be government bonds or so on and so forth. But this should be an invested asset class in central banks. Secondly, the stress tests within the financial community are very important because it would create awareness on what's the risk for holding, you know, all these assets that may be stranded in the future, and the impact on prudential.
So revised risk-weighted methods and inclusion in the stress testing.
Positively and negatively.
Yeah.
You know, maybe I can add that more than the carbon market, which definitely help, one should look at reducing the incentives to fossil fuels that still exist in many parts of the world. And then there is an added complexity that imagine that you have carbon pricing on a country that has heavily subsidized fossil fuels. How can they cope with this contradiction? So I think first and foremost, we should remove, which is not easy because it's a politically sensitive argument, the incentives to fossil fuels where they exist. And then on a level playing field, you can talk about carbon pricing. Otherwise, you get into these crazy situations where you can subsidize the use of a fuel and then carbon tax the result, which is like, I mean, people would not understand that at all.
This is ever so true, because, you know, speaking for the IMF, numbers haven't changed much. No. And if you look at the latest cost of subsidizing fossil fuel energy, if you include the direct and the indirect cost, we're still talking about $5.2 trillion.
And it's wasted.
Which is huge. Yeah.
Yeah, and that's only half. That's only one side of the coin, because I think carbon pricing is right, reducing subsidies is right, but there are a whole host of other externalities that exist that we know about that need to be taxed. Because externalities today are not properly priced.
But if you price carbon properly, then part of the externalities would be
yeah, it needs to be a combination of both.
Yeah. Okay. So because I'm not your supervisor, you have no advice for me. I take it.
I was also going to mention, you know, we've been talking a lot about the energy sector, but, you know, it's only a quarter of where the world emissions come from. So there are a lot of harder to abate sectors as well that in emerging markets need attention, agriculture, transportation. And again, you know, those of us in the private sector have a big role to play in terms of solutions, precision farming, technologies, et cetera, to bring to emerging markets. So for us particularly, we manage about 11 million hectares of farmland, and we are trying to bring solutions to investors of products like energy efficiency agriculture funds that are going to focus on reducing emissions. But I think we all have a role to play in bringing all those sorts of solutions as well. But you know, as I said, we've been working on this commission to six-fold increase financing in addition to that, there's expertise required, there's structuring done, there's market movements, products that we have to develop. So a lot of work.